Welcome Pictures presents the fourth video training series, Black Belt, 3rd degree, Keeping the Trade Journal. Isn't keeping the trade journal only for silly high school girls? What about their crushes? Heck yeah. Okay, not really. High school girls keep diaries. Traders keep trading journals. Two entirely different things. Get it right, for fuck's sake. Keeping a journal is actually a crucial task in any performance or goal-oriented endeavor. The key is to have some way to measure, track, and stay focused on improving your performance. World-class athletes do it to keep track of what helps them be better, faster, and stronger on the field or court. Scientists do it in the process of finding their next greatest discovery, and traders do it to help them get the ducats. What getting them ducats means, in simple terms, is to become disciplined, consistent, and most importantly, profitable. A disciplined trader is a profitable trader, and keeping a trading journal is the first step into building your discipline. This might sound simple or easy, but we assure you that to actually get started can be very difficult. In fact, many traders give up after a while and try to rely on the logs that the broker provides. The logs or transaction history from your broker gives you information that is, at best, marginally useful, as it doesn't tell you much of why you enter the trade and exit the trade. That information provides no help on your next trade. Absolutely fucking zero. A trading journal isn't about writing in the process of your entry and exit and the time you exited the trade. The trading journal is also about refining your methods and mastering your own psychology. To be even more specific, is it about your individual emotion psychology before, during, and after the trade? For example, your trading method says to buy the $yen, but your gut feeling tells you that the trade is not going to work. So you're reminding yourself, I don't think this is going to work, but I have to follow my trading plan, so I'll take it. During the middle of your trade, the price comes up 3 pips away from your stop loss, and you're thinking, fuck, this trade isn't looking good. I knew it. Why didn't I listen to myself? I'm such an idiot. I'm about to lose. I'll just exit now. Then you decide to close your trade. A few moments later, the price shoots up to your original take-profit target. Had you stayed in the trade, you would have made a shitload of pips. This is why you should write a trading journal. This is a classic case that probably happens to many traders. We fail to stay in the trade, we fail to trade the plan, and most importantly, we fail to distance our emotions from trading. If you keep it trading like that, and you don't keep a trade journal, the balance of your trading account will become a big fat zero before you realize what you're doing wrong. The benefits of the trade journal. Okay, enough with the doom and gloom. Let's just say that most expert traders keep a trading journal and review their trades consistently. And you know what the expert traders are, even though they won't admit it. They're ballers. They got the money, the cars, the clothes, they got ice. Maybe exaggerating, but only by a little bit. Besides helping you in your journey to baller status, there are other personal benefits to journaling. Defining yourself and your situation in life. Keeping progress of your goals you set in your trading plan. Clarifying your weaknesses and strengths in your ability to perform and handle pressure. Providing a way to self-coach and improve on your own. That last bullet point is probably the most crucial, as every new visitor that comes through criticalman.com doesn't walk down the path of your average Wall Street trader. Not everyone gets their master's degree and PhD in mathematics, computer science, financial engineering, whatever, then moves on to a big financial institution or proprietary trading firm. We're all average Joes, learning from home or wherever we can find an internet connection. This means we all have to trade from scratch and develop our own methods. Thankfully, because of the internet and trading forums, which were created by Al Gore, we can learn and connect with other like-minded individuals, both new and experienced, to shorten that learning curve. Even so, most of us lack access as a crucial asset to learning any task or skill quickly and efficient enough: a coach or mentor. A coach or mentor is there to guide you every step of the way, pointing out your mistakes, recognizing the things that went well, and keep you disciplined and accountable for your performance. A mentor of any caliber is hard to come by. For most new traders, it's impossible, so we have to do the next best thing, mentoring ourselves with a trade journal. A well-kept, detailed journal can be almost as good as having a coach watching over your shoulder. and helping you learn from those lessons. Hell, a trading journal may seem boring and time-consuming at times, but a trader that can more learn from reviewing their own trades than from reading a book or even attending a seminar. Over time, your journal will grow, and if you keep detailed records on everything about your trading, from psychological issues, the market environment, system tweaks, did you have decaf, it'll help you recognize important lessons like what news events should be avoided, how much more or less you need to risk per trade, when you should start trading online and stop playing online mini-golf. Also, how disciplined are you with your trade journal can be a great predictor of your overall trading success down the road. What you should record in your journal. The answer to that question is simple. Everything. You record everything you feel and do before the trade, during the trade, and after the trade has been completed. Trading is a performance skill, regardless of your trading style or method. Your outcome is determined by how well you analyze the market environment, your ability to create a plan or trading method, and how well you execute that plan, and a little bit of luck. There are many variables that lead to success, so you have to write down everything to determine your weak and strong points. For traders, this means recording who you are and your motivations for trading. To find the right trading method for you, you have to know who you are, your lifestyle considerations, and why you do the things you do. Market views and philosophy. This is how you understand the time frame of the markets and how you make the decisions to act and manage the risk of your account. Observations of the market. Each day is different in the market, but that doesn't mean there are certain tendencies or behaviors that you can take advantage of. With careful and consistent observation, you can find these tendencies and create and adjust your strategies to them. Also, if the environment changes, you'll be on top of the situation and change with it. Trading mistakes and missed opportunities are just detrimental to your success as the market's going to your trade. Closing trades too early, not taking legit setups, entering the wrong entry levels and position sizes, etc. should all be recorded in your journal so that you avoid making the same mistakes in the future. Performance statistics. Many aspects of your trading performance can be quantified into hard data. This gives you a realistic, no bullshit picture of how you're doing. Like Shakira's hips, the numbers don't lie, and sometimes a shot of reality can give you a kick in the butt that you need to kick up your game. Truth be told, this sounds like a lot, so to make things easier for you to get started, here we feel that the bare minimum are must-have elements to trade journal. Before we review all of this, we just want to point out that we believe it should be included in a trading plan. We simply provide a list to have a better idea of what to include in your own plan, but you don't necessarily have to follow it exactly. Here's our 5 must-have elements. Potential trading area, entry trigger, position size, trade management rules, and trade retrospective. Again, it's up to you. It's your trading plan. Just like your custom World of Warcraft character, you should customize your trading journal as you see fit. Remember, you are the one that's going to be benefit from writing a trade journal, so write down what you think would be the most beneficial to you. The potential trading area. You need to have a valid reason to enter your trade. This is also known as logic or rationale. You're not a caveman. You're not a gambler, right? Why are you looking to enter this area? The area is determined by whatever setup direction method you have in your trading plan. An example might be a crossover of 2 moving averages or price hitting resistance on a Fibonacci retracement level. Your potential trading area stands between current price and your entry trigger. We strongly suggest you take a screenshot of your chart showing this area. Try to make a habit of screenshotting your charts. When it's time to review your trades later, having the ability to see what happened visually will help you train your eyes to see possible opportunities or traps to avoid on your charts in real time. I will say this again. When it's time to review your trades, having the ability to see what actually happened visually will help you train your eyes to see possible opportunities or traps to avoid on your charts in real time. This will help remember the reason why you entered the trade or make you realize some things that you may have overlooked. The potential trading area is where you believe you will have an edge that you trade with a high probability of success and that the reward-risk ratio will be in your favor. You must determine for yourself how you want to meet this requirement. When you sat down in a chair in front of your screen, you were ready to trade. The potential trading area is where you aim. This will keep from entering a trade without a plan and shooting from the hip. The entry trigger will tell you when to fire. Your entry trigger tells that you once you're in a potential trading area when to actually enter the trade. This is your specific entry technique. Now that you've decided on where you're looking to enter the trade, now you have to decide on when to actually enter the trade and how. Do you just blindly enter? If you want to cross the street, you simply start walking across, only if you want to get run over. Of course, you look both ways to make sure that it's safe. The same approach is practical with trading. You want to make sure that it's safe to enter the market, i.e. a high probability trade setup. The entry technique will help you keep you out of trades that aren't behaving the way you would expect in your potential trade area. Let's pretend your potential trade area is where bearish divergence is present. Do you just automatically short, or do you wait for price to trade near a significant resistance level first? Maybe even wait for an exhaustion reversal candle like a shooting star to form. Instead of waiting, you short now, and then watch the price climb higher and get stepped out. Just because you find a good area to trade doesn't mean you should jump right in. A good entry technique provides solid confirmation to help keep you out of losing trades. Again, make a screenshot of your chart and label where your entry trigger is. Don't forget, you must combine a good entry trigger with a good potential trade area. A moving average crossover may be a popular entry technique, but if you don't factor in the area in which you're thinking to enter, you'll probably get whipsawed to death. Using an entry trigger as a standalone technique is a recipe for disaster. Make sure you're aware of your surroundings as well. Don't bring a knife to a gunfight. Or, for you kids out there, don't bring a tennis racket to your basketball game. Position sizing. This is an easy one. You must decide, based on your risk management rules and your trading plan, what your position size will be. This will allow you to know your maximum risk. 1%, 2%, 5%, 10%, 20%? Or are you going to bet the farm? Yeah, do it. Bet the farm. No, I was fucking kidding. Don't bet the farm. Have you been paying attention? You want to become a trader, not a gambler. Position sizing is important because it helps your account stay healthy and ready for the next opportunity. It is important to take note how big or small you're trading. By keeping track of your position size in your journal, you can see whether you are comfortable trading large positions or you prefer smaller lot sizes when using wider stops. The trade management rules. You need to have a game plan in place before you consider getting into the trade. That game plan tells you how you will manage the trade, whether it goes for you or against you. Entering the trade is an easy part. It is exiting the trade will determine whether you make or lose money. Two traders, Tom and Jerry, could take the same trade but have totally different outcomes. Tom will make money on the trade because he properly managed his trade and planned for an exit for different scenarios. Even if he loses, he will know when to stop the bleeding and get out with a smaller loss. Jerry, on the other hand, being a fucking mouse, does not have a plan in place. He does not know where he's going to do if the price goes drastically against him, eventually wiping out his account. It is crucial to determine how you'll manage the trade before you enter the trade. You do not want to be making critical decisions in the heat of battle. When you enter a trade, you should have already decided how you will react to every possible outcome. Every possible outcome. Try to figure out all the possible variations that could occur and decide beforehand what you will do. You want to be a cold-hearted, emotionless execution robot when at a trade. You want to be like Spock without the human side. You want to be a motherfucking Vulcan trader. All decisions are made before trade. You are proactive. This means that you are not yet in the trade. When deciding to enter the trade, you simply refer to what you wrote here. This eliminates any seat-of-the-pants decision-making. If you do take the trade, you already know where your initial stop-loss will be placed, what your profit targets are, if you will trail your stop, and where you might get out of your trade early. Pretend you're Keanu Reeves. If you are given a pop quiz at any point during the trade and asked, what if price does this? Or what if price goes here? You should be answering a snap without thinking for every single trade, every single time. You must have your trade management rules fully planned out ahead of time before the trade is initiated. You never, ever, ever want to think, what the hell do I do now when in a trade? If you do, you failed to plan. When you fail to plan to fail. The time to decide such things is always before you enter in a trade. Trade retrospective. Retrospective means to take a look back at the events that have already taken place. Once you finish trading, it might be tempting to call up your homies that hit up happy hour, kick back shots of Patron, splurge on bottles of Dom Perignon, but it's crucial that you review your trades win or lose. You want to look back over the whole process to understand what you did right or wrong. Here are some questions to ask yourself. How well did your trade work out? Was the position size sufficient to match the risk and reward scenarios, or was it too large, too small? Could you have entered at a better level? What tools might you have to improve your entry timing? Patient enough, or did you rush into things you never had a chance again? Was your take profit realistic, or a pie in the sky? Did the market pay any respect to the choice of take profit levels, such as stopping short of it, or did prices blow right through it? Did the market pay any respect to your choice of stop loss levels, such as stopping short of it, or did prices blow right through that? What news events or catalysts caused the market to move in the way it did? Use the answers to refine your position size, entry level, and order placement going forward. How well did you manage trade after it was open? Were you able to effectively monitor the market on your trade if it was active? If so, how? If not, why not? The answers to these questions will reveal a lot about how much time and dedication you're able to devote to your trading. Did you modify your trading plan in any way? Did you adjust your stop-loss order to protect profits? Did you take partial profit at all? Did you close out your trade based on your trading plan, or did the market surprise you somehow? Based on your answers, you'll learn what role your emotions may have and how disciplined a trader you are. While you may want to vent your thoughts, emotions, and feelings to your homies, it's better to write them down here. You're probably boring them to death anyway. They don't want to hear about your whining. What you can improve and what specific steps we take for your improvement. This is your opportunity for trader self-improvement. Do not write vague confessions like, I need to hold my winners longer, or I need to cut my losses quicker, or I need to be more totally fucking useless by themselves. Identify specific steps to improve. How will you hold your winners longer? Will you work on choosing better profit targets? Will you learn how to not freak out at the first sign of your unrealized profits failing? There are no right or wrong answers in the process. Just be as honest with yourself as you can, and be specific. Otherwise, you will not improve as a trader. Did you execute your trade according to your trading plan? Do not take this question lightly. If you're not routinely executing trades according to your trade plan, then you have a serious problem with self-discipline, or there's a serious problem with your trading plan. Either way, you have a big problem that needs to be fixed yesterday. Trade journal statistics. While your bottom line, total profit or loss, can easily tell you your overall trading performance, keeping statistics is a great way to find out what part of your trading system, plans, or processes are keeping you from running like a fine-tuned race car instead of a junkyard clunker. Your performance stats help you determine what's working, what's not working, what to improve on. Here are some statistics to keep at a minimum to track your system vitals. Net profit. This is your total gain minus losses and expenses. These expenses include cost of equipment, commissions, and other costs. This is basically how much to keep your account is up and down at a given time, minus the cost of trades. Win percentage. That's the total number of wins divided by the total number of trades. What percentage did you win the trades? Loss percentage. The total number of losses divided by the total number of trades. What percent of the time do you lose trades? Largest winning trade. This will be removed from your average win calculations. This is not necessary to do, but if you have an abnormally large win in relation to your wins, then taking it out will provide a more accurate look and expectations to your stats. Largest losing trade will be also removed from your average loss calculation. This is not necessary to do, but if you have an abnormally large loss in relation to your other losses, then taking it out will provide a more accurate look and expectations to your stats. Average trade gain. This is computed by dividing the total gain from all your winning trades divided by the number of winning trades. Average trade loss. This is your total loss from all your losing trades divided by the total number of losing trades. Payoff ratio per trade. That's your average winning trade minus your average losing trade. Average hold time. Divide your total holding time for all your trades divided by the number of trades. Profit long of long-short trades only. This stat helps you determine types of trade or trading environments you perform well in. Largest number of consecutive trades. This stat helps determining your max drawdown or worst possible scenarios you have experienced so far. Average number of consecutive losses. This stat helps in determining your average drawdown and controlling your potential max risk. Largest trading account percent of drawdown. This is the amount of your account your equity has gone down after your longest string of losses. Tracking feelings and mistakes. How well you execute your trading plan can be quantified, as well as your mental state when you trade. Keeping track of how you feel will help you avoid during frustrating times, like when you wake up right after a news event that you forgot about, and it pushes the market so fast that you try to chase it, but then your computer crashes, you lose power, and your dog goes running out of the house onto incoming traffic. By the time you get back online, you see the market has moved 100 pips in the direction you wanted to buy. Don't you hate it when that happens? You're probably not in a good mood to trade by then, so trading for the rest of the day may be a bad idea. Expectancy. In simple terms, expectancy is the average amount you can expect to win or lose per trade. This can be computed by multiplying the loss percentage by the average loss and subtracting it from the win percentage times the average win. This stat helps you determine the correct position size and how profitable your trading method is. Ideally, you should be keeping track of these statistics so you can compare and analyze your performance over a set period of time. The goal of collecting and calculating these stats should be able to find a way to maximize your expectancy, pips or dollars gained per trade, set the correct position size per trade, determine the trading conditions as suited to you. Reviewing your trade journal. After a good number of trades, you'll collect a lot of fancy schmancy data and observations on the market and yourself. How do you analyze it all? Again, it works pretty simple. Find what works and keep doing it. Find out what does not work and fucking stop doing it. Finding what works and doesn't work is about keen observation and asking the right questions. Refine your analysis of trading results by breaking them down into smaller categories, such as day of the week or specific currency pairs. Here's a sample of questions you should be asking yourself when you review your trade journal. Which patterns or tools work out best for you? Which do not? How can you adjust your indicators to get you into trades earlier or help you avoid whipsaws and fakeouts? Are you closing winning trades too early? Is it you need to adjust your profit targets or are you afraid of losing unrealized gains? Should you hold on to losing trades longer than you should? How can you improve your stop loss process? How often do you follow your trade plans? Of the ones you do follow, have you been profitable? What trade setup did you miss or not take and why? Was it a legitimate signal or set up according to my trading method or system? What could you have done differently to reduce this loss or maximize your gain? Are you winning more on trades with multiple lots or single lots? What kind of market environments have you been doing well in? Trending? Ranging? Or most of your wins or losses biased towards certain currency pairs? Which news events have brought the kind of volatility you are looking for to trade or to avoid? Which trading sessions have been the most favorable to your trading style? Are you losing trades concentrated on certain days of the week, such as Mondays or Fridays? The difficulties keeping a trade journal. Keeping a trade journal is pretty hard, but so is looting all your trading capital, failing as a forex trader, giving up never to return to forex trading again. Reminiscing about the good old days of simply being happy, which would you rather choose? Entering trades in a journal forces you to review trades in black and white, rather than simply relying on your memory, which for most humans is a fucking stretch. More importantly, a journal allows a trader to step back and review their trades as a group of trades, and not individually and ultimately random transactions. Sounds like a lot of work, doesn't it? Fuck yeah. But doesn't anything worth achieving require work? Keeping a trade journal is the equivalent of an athlete's practice. It is not uncommon for a professional athlete to spend far more time practicing or training for an event than actually participating in the event. According to Tim Grover, Michael Jordan's personal physical trainer, direct quote, Michael would go for 40 or 50 points one night, and the next morning he was right back at it in practice. He just couldn't take a day off. His mental toughness was unbelievable, but the reason was that he was so physically ready every day. He used to have a saying, I practice so hard because it makes the games easy for me. John Wooden, winner of 10 NCAA men's basketball championships, is known as one of the greatest basketball minds ever, ran a very strict and disciplined 2-hour practice, 5 days a week in preparation for a 40-minute basketball game. You know how much time that is? That's 10 hours or 600 minutes of practice for 40 minutes of the real thing. And that's not all. Not only did he stress meticulous and deliberate practice, he kept a log of how every practice went. Coach Wooden would refer to his practice logs if a team had a problem he couldn't solve. For example, if his current team was shooting poorly, he would research his old practice logs to determine how he improved shooting. Even in the days of no computers or iPads, Coach Wooden understood the importance of strict record keeping. While the act of journaling really isn't that hard, it does take consistent time and effort. It's definitely a time-intensive process. This summary for a trading journal is that there are 3 elements for sustained, successful trading. Having and executing a good trading plan. Having a good trading system as part of that plan. Review and improve your trading performance and plans. Every trader should maintain a trade journal that focuses on these elements. Your trade journal is a log of all trading activities. The journal's objective is to monitor both the performance of your trading system and your ability to execute it with consistency. Follow your plan. Poor trading systems are less frequently the cause of poor trading performance than the inability of the trader to properly apply them. That's following the trading plan. Your trade journal is intended to make sure you do just that. A trading journal provides any serious trader who wishes to make money a tool to help them evaluate themselves objectively. Journals are not only what is written in them. If one fails to accurately track trades, it becomes hard to judge trading performance. Start to maintain a trade journal. These both should be ongoing efforts, not just one-off for the sake of completing an assignment. Be thorough and honest. Do not shortchange yourself by failing to put in entries or through completeness. Learning to write and maintain a trade journal will build discipline in you. Not only that, when your reflection entries a month of trading will guarantee you learn a lot about yourself and your trading psychology. You will clearly see what you're good at, what you fucking suck at, and what is the best way for you to trade. This is something no mentor, no book, no video, no seminar can teach you. You have to experience it for yourself. Only through this experience will you become a successful, long-term, profitable trader. To build the skill of trading, you have to maintain a trading journal. Here's some final advice to help you in your trading journal. Always begin the journal before the trade and end it after the trade. Write down everything. Don't leave anything out. Be honest. If you decide to play Call of Duty while you're in a trade and forgot to exit your trade, write it down and explain why. Pay very close attention to your emotions. Make sure you write them down. Make sure your journal includes observations about you and your trading in the Forex market. We found that trading journals are usually skewed towards self-analysis and include little in the way of market observation. Take a screenshot of intraday charts and each day's action and write comments on them. Make notes of patterns that you are watching for. After a couple of months, you'll start to see the patterns emerging in real time. The trade journal is a learning tool and a great mechanism for training your eyes to see the setups you want to be trading. Nothing is too silly to record inside your journal. Write it down. Write down whether you missed a trade because you're watching the latest episode of Friends or playing Modern Warfare 2 or you're busy talking to your sweetheart. Write it all down.